Episode 17. There are typically 17 vertebral bodies in your thoracic and lumbar spine. I grew up playing junior golf at Cataraqui Golf and Country Club in Kingston, Ontario, which was founded in 1917. Only $600 a year as a junior golfer. Hard to beat that for a top 100 course in Canada. The greatest athlete to wear the number 17 is Yari Curry. Beyond MD, episode 17. Here we go. Welcome back, everyone, to the Beyond MD podcast. Today's episode is going to cover an introduction to private equity. Now, why do I bring up private equity? Well, I think many of you know by now that I am a fan of multiple baskets. And it's not that I myself invest in private equity, but I do know several physicians who have been very successful with it. And my belief is knowledge is power, and the more we know, the better off we are going to be. So in my opinion, private equity is a basket that we should be taking the time to educate ourselves about. So let's get any conflicts of interest out of the way immediately. So my guest for today, Ron Haik, is in fact a senior financial advisor for Nicola Wealth, which is a private equity firm. But as you will see in the interview, it's a very balanced conversation. No one here is trying to sell private equity. Rather, we're just trying to educate and inform and differentiate private equity from investing in the public markets. And be sure to tune in until the end of the episode, because after the interview, I will go over 5 questions that Ron has provided us. And these are questions that he feels are really important for anybody to be asking any private equity firm if they are contemplating going down this route for investment. Now, a little bit on my guest, Ron Haik. Ron is the senior financial advisor at Nicola Wealth's Toronto office with over 25 years of experience in the financial services industry. He's gained a breadth of experience working with some of the world's largest financial institutions, advising clients in a variety of roles, such as financial planner and investment advisor, in the areas of domestic and offshore planning for the high net worth segment. Ron's unique experience working in the private banking world, both internationally and domestically, gives him critical strategic insight into his clients' financial needs. Ron is a seasoned lecturer at industry and association conferences, seminars, and post-secondary schools across Canada. As a subject matter expert on investments and planning for incorporated professionals. In addition to his CFP, Ron holds an MBA from the Schulich School of Business. He's married with 4 kids and 2 dogs and is an avid runner. Now, guys, one thing I have to mention, my audio quality on this interview, something happened, the mic cut out. When I listened to it, I was kind of scratching my head. I tried to smoothen out the voice using GarageBand, but there's only so much you can do. Now, while I'm on this topic, if I could pick a voice for autotune, I would pick Bryan Cranston. That voice is deep, it is sexy. I wish I could have it, but I don't. But the one thing they say that does happen with age is as you get older, your voice gets deeper. I can't wait for that. So I guess that's one of the good things that happens with age. But anyways, without any further delay, here's my interview with Ron Haik. Hey Ron, it's a pleasure to have you on here today. Where does the podcast find you?
Thanks so much, Yatin. Today, podcast finds me in the heart of Toronto at Avenue Road, just north of the 401, working from home, where I have been for almost the year plus, though we started to migrate back into the office a little bit over time and really enjoying some of the serenity that's available at the office.
Hey, very good. And, I'm really excited to have you on here today because one of my goals in the podcast is to really be exploring different ways of investing, going beyond the stock markets. And I think that is resonating with people. So, I'll tell you this, my investing journey started several years ago where I started to buy ETFs and buy stocks. And then what I did was I actually told one of my friends who's a senior physician to me and, very savvy financially. And he told me basically this, he said, okay, congratulations for starting. And you've got your play money in now. And when you're ready to do some real investing, I've got 2 words for you, private equity. And at the time, I actually didn't really know what to make of it. I didn't know anything about private equity. And I do believe that with that statement, he was half serious and half joking. Because truth be told, I know he invests in the markets, I invest in the markets, and I know a lot of others who invest in the markets. And we know that over the long term, that markets are typically going to go up. So it's a good strategy. But I believe his message was that for those who are interested, there are options other than the markets available. So with that in mind, Ron, maybe you can tell us, what is private equity?
Absolutely. So private equity essentially is ownership or shareholder in a private business. Private obviously means outside of the public area, so it's not traded on a public exchange of any kind. And they're private businesses in all sorts of industries, and then they come all different sizes as well, from your corner dry cleaner to multi-billion-dollar empires.
And maybe just a quick overview on kind of the major ways in which investing into private equity might differ from investing into the stock markets.
So, four major ways they might differ. One might be greater control or influence, and I'll get into each one shortly. Second might be long-term horizon in private equity, access, and then finally liquidity. So, when we talk about greater control or influence in the private equity arena, typically when you invest in the publicly stock market, you have very little influence over what's going on in a publicly traded company. You're an individual shareholder. But in a PE or private equity, I may use that interchangeably today. PE, typically one has invested alongside a group that has control or at the minimum has some influence at the board level. And in the stock market, as I said, it's very difficult to have that voice. You hope that the board is truly independent from management, but that's not always the case. The second point is the long-term time horizon. In a private equity scenario, typically you're taking at least a 5 years or greater view. You want time for the new owners to come and make an impact. And so you're not typically going to see that in the short-term price movement. That's what you would see in a stock market, a lot of short-term volatility. In terms of access, typically private equity requires about a $10 million minimum investment. And for a diversified portfolio of private equity businesses, you need about $200 million. So access is really defined by a dollar threshold. Our solution is a little different. No minimums for our clients. You get immediate diversification and certainly much lower minimums than in public markets. And then the final differentiator versus regular equity is liquidity. It's much less liquid. So when you're buying and selling on the stock market, you could do that at the drop of a hat. You mentioned ETFs a few moments ago. You could do that online at any point. Buying and selling PE takes sometimes months of due diligence, negotiation. In Nicola, it's a little bit different. Again, it's a 9-year-old evergreen fund. We have typically older investments in there, and they create a liquidity for our clients as needed.
Okay, Ron, that's a really, really good overview and so much to kind of unpack there, which is what we're going to start to do now. So maybe just tell me a bit about Nicola Wealth and kind of how long has the company been running, and maybe just summarize the mission, the vision behind it.
Thank you. So Nicola, in this fashion, has been running since 2000. John Nicola founded Nicola Wealth back in 1998, and in 2000 we started in this format that exists today, and it's evolved to what it is today. We manage about $10 billion for Canadians and their families. We are not an institutional money manager. This is just personal high net worth individuals. We're very comprehensive in our financial planning, 2 advisors working with every client file. So once we finish the comprehensive financial planning, once we understand the goals and objectives, it's only then that we move to an investment solution that may include, and often does include, a slice of private equity. And so, when you talk about the vision is really to take an institutional Canada pension plan model and bring it to the high net worth market. And part of that, obviously, has been the use of private equity. Private equity we've been using since May of 2012, and really the vision is to provide our clients access to this unique but hard to access asset class through this structure, and it gives them instant exposure and diversification.
Okay, beautiful. And so you talked about like a Canada pension plan type model and kind of bringing that to high net earners. So maybe you could just tell us now a little bit about the funds. Let's say somebody makes a decision and they want to invest into private equity with Nicola Wealth. How can we divide up the funds? Is it safe to say like is there a venture capital component, a capital growth component? I'm just going to ask you to maybe summarize what are we going to be investing into, and maybe just some of the sectors that are covered and geographies that are covered too.
Absolutely. So we invest primarily in North America, though we do have a global investment component through our global equity and global bond funds, small global allocation to real estate. We do have all the major asset classes that you would have, whether it's fixed income, preferred shares, high yield bonds, but and publicly traded equity markets, of course. But where we really add a lot of value in addition to that is our private funds, if you will, and that's private debt, our Nicola Real Estate Funds, the Nicola Infrastructure and Renewable Resource Fund. And we're constantly trying to offer our clients better risk-adjusted returns. So we're always thinking about how can we make good better. And we're right now in discussion, and there are discussions internally of a new venture capital fund that we're looking at. So the private equity fund is obviously a big part of what we do as well.
So when somebody says that term, a venture capital fund, is it safe to say that that consists mostly of companies that are kind of new and startups? Is that reasonable to assume?
Absolutely. So typically venture capital is early stages of a startup, whereas private equity is typically a more established business.
And I had, I think, heard you talk on another podcast. I think it was the More Money podcast, maybe back in 2019 with Jessica Morehouse, I think. And I think you were talking about kind of what composition real estate has in the fund. So what percentage of the assets at Nicola Wealth are kind of sent over to real estate, invested in real estate?
So real estate is a big differentiator for us.
Yep.
On average, about clients have about 25 to 30% across our various real estate funds. We manage real estate in-house privately. We do it all in-house, except for our global component, which we sub-advise out. But our North American portfolio, our Canadian or US, our value-add real estate is done in-house. We have a team of over 30 professionals, everything from the financing, the mortgage, the asset management. We do it all in-house. And we do it through a partnership strategy. And that's really always been our approach is, find someone who's doing it well, partner up with them, learn, and we've adapted that model to the private equity model as well.
Now, Ron, in preparing for this episode, I did come across a few terms that I'm hoping to clear up. One of them was a leveraged buyout. I'm hoping you can just kind of clarify, like, what is a leveraged buyout, and maybe what is the relevance to investors who are deciding to invest with you guys?
So it's a big component of private equity specifically. So buyout is really the core strategy of our private equity fund, where you're buying mature cash flowing businesses. So at the margin, we may invest in a growth equity opportunity, but the bulk of the portfolio is a buyout. So a leveraged buyout just simply means using debt or leverage to buy a business. In simple terms, you're borrowing money and you're buying a business. And you want to be able to leverage that opportunity to create greater cash flows. So we are very sensitive to debt. We prefer less, but really focused on what makes sense for the underlying business.
And now maybe you can shed a little bit of light, Ron, on like who are the individuals working at Nicola Wealth who are kind of managing these funds? I'm assuming, there are certain credentials that have to be met because these are large amounts of money, and you're working typically with individuals who are, higher earners. And then to figure out kind of what companies to acquire, where to put the money, that's not an easy task. So I'm assuming it's much more than somebody who did a commerce degree or an MBA and just decided, I want to get into private equity. Just tell us who's managing the funds and their credentials and background.
Yeah, so the great question, and it's a question one should ask of any advisor. The way we work in a committee basis. So we do have an independent investment review board. We have a chief investment officer. And so specifically on the private equity, you also have a portfolio manager. So all of our Nicola funds are subject to the investment review board, the chief investment officer. So there's a strategy in place. But the funds themselves are managed by individuals with assistance from other individuals within the firm. And specifically, our private equity fund is managed by Kazuki Nodomi.
Mm-hmm.
Now, Kazuki has been managing our private equity fund and private equity since September of 2012, so almost 9 full years. Our approach is, we do have a team approach. John Nicola, who's our chairman, David Sung, who's the president, Bijal Patel, who's the head of private capital, and we have 2 external investment committees who oversee specifically private equity. And you talked about credentials. So Kazuki's credentials, for example, New York University Business School, CFA, which is a chartered financial analyst, and he's been managing equity portfolios since 2002. And in fact, he learned at the TIAA in New York, and the TIAA is the Teachers Insurance and Annuity Association. It's a 100-year-old organization that was actually started by the Carnegie Foundation as a way to help fund the retirement and life insurance needs of teachers in the U.S. So certainly some strong credentials. But a big part of what we do is working alongside other qualified professionals. And and we do so in an evergreen structure.
I'm really glad you mentioned that, because my next question was, I've heard about the Evergreen structure, but can you tell us a bit more about that?
Sure, absolutely. So, a traditional private, unlike a traditional private equity pool, an evergreen structure is a perpetual vehicle, which means we take a longer term approach. Traditionally, most PEs have a 10 or 12-year finite life after which investments are typically sold. So you're buying into a specific PE or private equity, and you're told you're going to have to wait 5, 7, 10, 12 years, and that's it. Uh, in our scenario, we're not bound to that. We're unique in that 99% of private equity is a closed end, which means in order to invest, one has to have a finite window, and you can't get in once that's done. Traditional PE pools are typically what's called a blind pool. It means you don't know what you're actually investing in. You trust that the managers are going to buy the types of business they said they would, but it's not always the case.
Mm-hmm.
With an evergreen structure like ours, you can actually see what's in the portfolio and all the investments you're actually buying into on day one.
Now, maybe just shifting gears and focusing on the investors. Like, let's say you're an investor and you've decided, I want to invest in private equity. And if they're investing with Nicola Wealth, you mentioned, I think earlier, perhaps there is no minimum. I'm just wondering, typically though, does somebody have to put in a certain amount to kind of get started, or?
No, I mean, that's a nice thing about our evergreen structure. The actual pool doesn't have a minimum. What we look at with our client offerings is, typically we like to see client assets at $1 million or greater, and that could be across their, corporations, personally registered accounts. But that's typically what we're looking for as a client. But the pool itself doesn't have a minimum. So it allows us to get some immediate diversification for our clients right off the bat.
Okay, good to know. And let's say one invests into private equity with Nicola Wealth, and let's say over a certain time frame, there's a 20% return. I've heard of so much different lingo that comes with returns, like maybe an initial management fee, a hurdle rate, a catch-up rate. So I'm just wondering, if the return for the investment is 20%, someone might ask, okay, well, what's my take-home return? Can you kind of help us understand this and maybe some of the lingo that comes with this?
Absolutely. And you hit on a key feature here of all funds, which is, what's in your pocket after everything, really.
Yeah.
That's what matters. And so if you're investing in a traditional private equity, typically there's about a 600 basis points spread between their returns and what's left for investors. So if a typical PE manager returns, say, gross 20%, their net returns to you after management fees and performance would be about 14%. But that number isn't really off of what you commit. It's on what we call on the draw, or what you drew, because it's not typically the full amount you committed, typically 80 to 90% of your commitment. Also, when we talk about commitment, it takes time for them, the managers that is, to deploy. So each year they call on your commitment. You may have given them a 10, 20, or $30 million commitment, but they're not taking it all at once. So often it might take 4 or 5 years for them to draw on that, and then they start sending you money back over the next 5 years. So in reality, really only half of what you commit to them is actually at work. And then you start to think about needing to set aside your commitment in safe investments, because they could call you any day and say, hey, send me that 5 million or send me another 10 million that you committed to. So while you're waiting for the PE manager to draw, now there's a drag on your returns as it sits in safe investments. So we've done some analysis and found that could be another 200 basis points drag on your return. So that 14% that I quoted a moment ago, maybe it's closer to 12%. But there are things that you can do to mitigate this. What we do is we try reduce our exposure to traditional PE funds with high fees. So a big part of what we do is try and increase our weight in what's co-investments, where we're actually investing alongside. Often these have no fees, and they're not managed by, and they are managed by our existing PE managers. We can speak in an example a bit later, but we focus on co-investments for a while, and about half the portfolio right now is co-investments.
Okay.
Second thing we try and do to mitigate costs for our clients is to focus on funds with better fee structure. So if a traditional PE charges 2% on committed capital, which can be a big draw, particularly at the beginning, a big drag, on returns, particularly at the beginning, So what we might say is on a $10 million commitment, that might be $200,000 a year of management fees going out. So this is really in the early years when there's limited capital deployed. These fees are a big drag on return. So we might ask for better terms and conditions as a result. So we focus on funds that charge fees on invested capital rather than committed capital.
Okay.
Of course, what we want to do is we want to see a strong track record from our managers as well. Hard to find, but we continue to look for them. We think, for example, one that we're partnering up with today, Northern Private Capital, is a great example. And then the last thing we try to do in terms of mitigating that drag is, now that we have more scale, we can see a significant investor with some PE. We can be seen, as a significant investor with some PE managers, which offers us a better fee model than a typical 220 closed-end fund.
Okay, so what I'm hearing is that you guys do obviously make the effort to kind of maybe mitigate that drag on returns. And so you mentioned a few things. So it would be fees on invested capital, not committed capital. I'm getting that right?
Correct.
With all that in mind, then let's just say if we take that kind of 20% return with Nicola Wealth, is 14% kind of a reasonable ballpark to be taking home? Or
yeah, and I think what you're speaking of is a really important part, which is transparency and accountability. So we put on our website, for our clients, for our competitors, for anybody who would like to see, go to nicolawealth.com and you will see all our returns for every one of our funds, net of all fees. And so it's really important, we think, to be able to demonstrate to individuals, not just what you have done, but what you're currently doing and what you're investing in. And so I talked about having blind pools. If you go to our website, you will actually see what we're invested in the private equities and the returns associated with that.
Okay, that's great to hear. Now, with the way the equity market, like the stock markets have been performing over the last couple of years, someone may say, well, hey, listen, I'm up big in the last year. So like how could returns in private equity compare to the stock markets? And I'm just trying to get a sense of maybe over the last 10 years or since, Nicola Wealth became a reality, how have returns compared to the stock market? And I'm wondering if you can shed light on good times versus bad times, just so people can get a sense.
Yeah, and I think that's a great question. How does private equity, investing compare to publicly traded equities investing? And I think what we need to understand is that you typically aren't going to see as large a swing in private equity as you would in stocks, because these are private assets. They're not traded on emotion on a daily basis at the touch of a button. So yeah, it might mean that, in years like last year was a perfect example. You might miss out on some extreme positives. If we saw a large run up after March of last year, but you're also going to miss a lot of the downside. You're not going to have those wild swings in the negative years as well. And last year was a perfect example of both the downside and the upside. Overall, the long term, what would we expect? We would expect that this should outperform the stock market. Part of what we would expect is what we would call, an illiquidity premium, because typically PE or private equity is not liquid like stock. You should be paid a little bit more. And typically what we would see is about a 2% outperformance or greater over the long term. So the nice thing here, relative to, we're not suggesting you shouldn't be in public equity markets. We're suggesting there should be an allocation of private equity to replace some of your typical public equity exposure. And then overall, you should expect a better rate of return as a result.
Okay, I think there's a lot of good information there, because I know, Ron, myself and a lot of other people, we're always fixated on returns. And we tend to look at this on a daily basis, quarterly basis at the very least. But then one thing that's also important to me, and I know to other people, is downside protection. Like I want to know what's going to happen to my holdings in a bad year as well. So it sounds like, from what you're saying, that private equity typically might offer a bit more downside protection then, compared to the stock markets in a bad year.
We think so. Compared to the stock market, private companies are often times, but not always, smaller. So they typically have a long runway for growth, which means there's greater upside. It's a private business, so, but just like public companies, they can go to zero.
Yeah.
Think about a challenging industry or bad management or too much debt or a COVID, pandemic hit something that you were invested in. It can happen to both public and private businesses. So what's really critical here is stock selection or investment selection. But the difference, unlike public companies, private equity is less beholden to public market sentiment.
Mhm.
If a company needs capital, a PE manager can think long term whether that makes sense. But a publicly traded company, if it needs financing and the market is either too short term looking right now or too bearish or both, it can really impact a public company's ability to raise capital and survive. And lastly, private equity investments can be highly negotiated, which means there are sometimes opportunities where we can structure our investment so we can get some downside protection, maybe through preferred equity that's senior to the common equity.
Okay. And in terms of the time horizon, you already commented on this. I think it's a longer time horizon. So safe to say minimum 5-year investment horizon for somebody who's considering this. Is that safe to say, or even up to 10 years?
Well, for our clients, we're always taking a longer term view of their financial plan, which ties into the investment solution. So, 5, 10 years, again, is not a number we look at, because from an investment perspective, because our private equity pool, you can get out of it. You're not tied into it for 5, 7, 10 years. You can get out within 6 months. It isn't an issue. There is that redemption availability because it's an evergreen structure.
Yeah.
It is more about, as a firm, what kind of investment horizon do we take? We always take a long-term view on our private equity investments. So we're happy when things work out sooner, than expected. Our recently we had an investment with MDA, more than doubled in 1 year. We're very happy with that opportunity to we can exit in 2 years, but we went in thinking that it's at least a 5-year hold.
Now, Ron, when I recently did an episode on mortgage investment corporations, one of the themes that came out of that episode was it's really important to kind of know who you're giving your money to and how they're conducting their day to day. So I'd just love to know, without you spilling all your secrets, I just want to know what kind of approach does Nicola Wealth take into evaluating a company? Because I feel like that's kind of at the heart of private equity, but maybe you can just kind of talk us through some of this.
Absolutely. So first of all, we're assessing the quality of the business itself. Is the industry attractive? How has the business performed through 2 cycles? How have the margins and cash flows been? How robust or strong is their earnings? What are the industry trends that may impact the company on a go-forward basis? How has management performed? What have they done well? Where are the opportunities to improve? Where can we add value? And what are the risks to the business, and how is management mitigating that? It's not just about what their plan A is, but what's their plan B and plan C? You want to always look at this from a worst case scenario. If this goes wrong, what is my out or what is my exit? You want to have that. That's how we limit the downside protection. You can't limit it all, but there's certainly examples that we can go through, and happy to discuss one with you.
Yeah, that's what I'd love to get into. Maybe you can kind of just walk us through an example of maybe a recent investment or acquisition where you thought maybe, or the company thought that the sector was a good fit, the company was a good fit, and what kind of led you to that decision?
I think maybe the most recent one we could, and I mentioned it a couple times here today, was MDA. It was the former McDonald Detweiler and Associates. So many of us growing up might remember the Canada arm on the space shuttle. That's the firm there. So it's historically, the business was strong and steady, good margins and cash flows. And the reason was, quite frankly, they're in attractive end markets, and they have technology and intellectual properties in specific areas. So it's not an easy business to get into, if you will. So businesses like satellite antennas, satellite communications, as well as space robotics. The other thing we liked about it is it's not a cyclical business. It didn't matter too much really how the business or consumer cycle was. Their end customer was very stable. You think about government contracts and so forth.
Yeah.
The deal dynamics itself was very attractive. So the seller in this case was a publicly traded company that had done some bad acquisitions and had gotten over-levered. And so it had to sell, which means we could get in an attractive price.
Got it.
And then finally, we think that an important part of the diligence was getting conviction in the outlook, and specifically 3 key business units that would grow substantially through contract wins. And the way we got that confidence was, again, we have a partner, Northern Private Capital, that it manages part of our PE fund, but we were able to come alongside and they shared their findings with us, and we got conviction real quick on that one. The thesis is playing out, and really, even without this growth, the underlying business generated enough cash flow that we'd still be able to get an attractive return on our investment. And as I said, in 1 year, we've seen a doubling, and we expect to continue to see good things from MDA.
Yeah, that's fantastic. And I think through that kind of analysis, you basically outlined, I think, a bit of a triangle. So you've talked about the industry, the trends, cash flow management. So all looks like all important things to think about. And then earlier you mentioned risk. So I just want to know, what's the worst thing that can happen with a private equity investment? Like, how often does this happen? I imagine it's just, a company just goes bust and the entire investment is lost. But maybe just talk to us about the worst case scenario.
So yeah, you're absolutely right, Yatin. Similar to the stock market, you got to be very prudent how you invest. First of all, you got to partner up with the right group. You got to be prudent in the types of businesses and the funds that we invest in and the groups we partner up with. So spend a lot of time doing that research, that due diligence. These are long-term investments, which means they require investors with long-term time horizons. So unlike the stock market, where there can be high-frequency traders on one end and long-term investors on the other, private equity is structured such that really only long-term investors can invest. So we were making sure that we're partnering up with the right people on that end of things. So, what can go wrong with PE? I suspect, what can go wrong with PE is it essentially could go to zero, one of your investments. The way to mitigate that is do a lot of work up front and say no to more deals than you say yes to.
Okay, I think that sounds like pretty sound advice. And as we just kind of wrap up, Ron, maybe you can I'll give you the mic here now to just pass on any advice to an individual who's maybe reaching that stage now of wanting to diversify their investments and starting to kind of open the door to private equity. What should they know? Any advice you have?
Thanks, Yatin. I think PE is an attractive asset class. It has strong long-term returns. It does require patient capital. But all of this really, investors should view this as an important component to your equity strategy alongside public equities, because that's where the liquidity is on the public equities. There's also a reason why all the major institutional investors' pension have a significant strategic allocation to private equity. It's typically hard to access, but we think we found a unique solution and structure for our clients. And then I think finally, if I could just end with one note, always start with a plan and always revisit that plan. That not investment plan, start with your financial plan, look at that, revisit that on a regular basis with your advisor, and then see whether there's an opportunity for private equity or other investments to go alongside that.
All right, I love it. Ron, I just want to thank you for taking the time to be with us. I know we kind of connected in the fall, and I want to thank you for tuning into my podcast, learning about it, and then just proposing this topic, because I think it's a great suggestion, and I keep harping on this, that I think it is important for us to focus on knowledge being power. And I think the more we learn, the more awareness we generate. And I think in the long term, that can be a good thing. So thanks again, Ron, for taking the time.
Thanks for your time today. Have a wonderful day.
All right, let's go over Ron's questions that he feels we should be asking any private equity firm before we decide to invest. Number 1, what types of businesses do you buy, have you bought in the past, and do you expect to buy in the future? This essentially dictates the nature of the investment, and it will determine if you get dividends, if you get them early on, or if you're going to be relying more on capital gains for your return. Question number 2, how much skin in the game will the private equity manager have? So essentially, this is important because it dictates whether the fund manager is going to be making money more off of fees or more off of their own personal investment inside that private equity fund. Question number 3, why do you think you're better than others at sourcing and doing due diligence? And how do you compete for deals, and what's your advantage? Question number 4, how much risk are you taking on? Ask them about the different types of business risks, and ask them about which companies in the fund are going to be more secular versus cyclical. So again, a secular company is not going to be as influenced by short-term market forces, whereas you can expect a cyclical company to go more up and down. Also ask them about how much leverage they are using. And question number 5, really take the time to dig through their track record. So look for returns over as long a period as possible for the various funds that you're interested in, and ask them where they did a good job, where they failed, and what types of investments they made in the past 2 years. All right, guys, that's it for today. Thank you so much again for tuning in. Thank you for reaching out. If you want to connect with me, beyondmdpodcast@gmail.com or hit me up on LinkedIn. We'll see you in about 3 to 4 weeks. Until next time, stay well and stay savvy.